In March 2023, capital rotated hard out of tech and into energy within 11 trading days. My momentum scanner flagged XLE surging volume, 2.3x its 20-day average, while QQQ's relative strength dropped below zero. That's sector rotation in real time, and I was positioned before the headlines. Sector rotation is the systematic movement of institutional capital between market sectors as economic conditions shift. It follows a predictable cycle. Early expansion favors financials and industrials. Late expansion favors energy and materials. Contraction drives money into utilities and healthcare. This cycle is the map I trade from. The edge here is institutional inertia. When a large fund rotates, it takes days to fully deploy capital. That sustained buying creates detectable momentum. My bot scans 11 SPDR sector ETFs every hour, ranking them by a composite score, price momentum over 10 and 30 days, plus volume deviation from the 20-day mean. My entry signal requires 3 conditions aligning simultaneously. First, the sector ETF's 10-day momentum score must rank in the top 2 of 11 sectors. Second, volume must exceed the 20-day average by at least 1.x. Third, RSI on the daily must sit between 52 and 72. Strong but not overbought. All 3 or no trade. Once a sector qualifies, I don't just buy the ETF. I run a secondary scan on individual stocks within that sector, filtering for those showing EMA 9 crossing above EMA 21 on the daily, with relative strength against the sector ETF above 1.0. I want the strongest stock inside the strongest sector. That's where the real momentum lives. Position sizing follows my standard rule. Maximum 2% portfolio risk per trade, calculated dynamically. I set the stop loss at 1.5 ATR below entry, then compute share count so that hitting that stop costs exactly 2% of the account. This keeps drawdown controlled even during rapid rotation reversals, which happen more than people expect. Exits are rule-based, not emotional. I exit when the sector drops out of the top 3 in my momentum ranking for 2 consecutive hourly scans, or when RSI crosses above 78, or when the stock's EMA 9 crosses back below EMA 21. Whichever triggers first closes the position. Target risk reward is 1 to 2.5 minimum before entry is even considered. In paper trading over 6 months, this strategy produced a 58% win rate with an average risk reward of 1 to 2.3. Sharp ratio sits at 1.41. The losing trades cluster during choppy, range-bound markets where sectors rotate without conviction. High noise, low signal. That's the honest limitation you need to know up front. The strategy breaks down in 3 conditions. VIX above 30, because fear overrides fundamentals and correlations collapse. The first 2 weeks after a Fed announcement, because macro shock reprices everything simultaneously. And during earnings season in the target sector, when single stock risk overwhelms the rotation signal entirely. I filter these out programmatically. Building this yourself starts with the SPDR ETF ranking loop in Python, feeding hourly OHLCV data from Alpaca's market data API. Calculate rolling momentum and volume Z-score, rank sectors, then scan constituents on signal confirmation. The architecture is straightforward. The discipline to follow the rules without overriding them is the hard part.